Welcome to the Deep Dive, the show that cuts through the noise and gets you straight to the most important insights. For you, the curious learner, it probably feels like the crypto world is just moving at lightning speed, right? News stories every single day. But, beneath all those headlines, there's a really serious conversation happening about how to actually make sense of it all. And that's exactly what we're here to do today.
That's right. I mean, the sheer growth of digital assets, topping over, $2 trillion in global value in 2024, that's presented a really complex challenge for regulators worldwide. Many have struggled, to develop that finely tailored approach that balances mitigating risk with, allowing for creativity and development. It's a real tightrope walk.
So today, we're taking a deep dive into this complex, fast-changing world of crypto regulation, our mission, to unpack the stark differences in how the U.S. and the EU are tackling this space. We'll look at how new legislative efforts are aiming for clarity, and crucially, what all of this means for the future of digital assets. Everything from protecting you, the investor, to fostering innovation.
Yeah, and we've pulled together some really recent insights to paint a sort of real-time picture of this pivotal moment for crypto. Our sources include key takeaways from a major digital asset compliance summit, a Q1 2025 market review, some detailed legal analyses, and significantly brand new European regulatory guidelines issued just today, July 11th, 2025. Plus, we'll also be looking at what's happening with Crypto Week in the U.S. House. So yeah, these sources really highlight just how quickly things are shifting.
Okay, let's unpack this global picture then. Our sources point to this striking disparity, right? How regulators are tackling digital assets. On one side, you've got what looks like a comprehensive, unified approach. On the other, seems much more scattered, still evolving. What's really driving this fundamental difference?
Well, what's fascinating here is the fundamental philosophical difference at play. I mean, despite crypto's mainstream growth, we're talking over $1.3 trillion in on-chain value received in North America alone between July 2023 and June 2024. This lack of uniform market regulation isn't just a headache for compliance teams. It creates dangerous gaps. Gaps that become, as one source put it, a petri dish for criminals.
And these aren't just like theoretical gaps we're talking about, are they? This is real money, real impact.
Oh, absolutely. We saw roughly $39.6 billion in illicit transactions back in 2022 alone. Now, while that number has been dropping in 23 and 24, it still represents tens of billions every year. And this leaves investors particularly vulnerable to fraud. We saw that highlighted in cases like SCC versus Terraform Labs, which tragically wiped out over $40 billion in market value for its victims. That's just a staggering figure, isn't it? It makes you wonder about all the individual stories of loss behind that number.
Wow. So, okay, on one side of this global divide, you mentioned Europe. They represent nearly 20% of global crypto volume, and they're taking this really bold, comprehensive stance. They've rolled out MiCA, the Markets in Crypto Assets Regulation. It's already being phased in across member states.
Yeah.
How is MiCA really poised to change the game here?
Well, if we connect this to the bigger picture, MiCA is really significant because it's the world's first truly comprehensive cross-jurisdictional regulation strategy for crypto. This isn't just about rules, it's Europe making a calculated bet, you could say, trying to become the global crypto standards setter, potentially forcing other jurisdictions to follow suit or, risk being left behind in a fragmented market. Its objectives are pretty clear. Set up a legal framework for digital assets not currently covered, promote innovation through clarity, boost consumer and investor protection, and enhance financial stability.
That sounds incredibly ambitious. So from a practical standpoint, how does MiCA actually achieve this balance? What are its core mechanisms? Who does it really impact on the ground?
Yeah, MiCA casts a wide net. It covers a really broad array of activities, things like crypto asset custody, operating trading platforms, exchange services, execution and transfer activities, providing advice, portfolio management, the works. Issuers and service providers operating under MiCA, they have to register, get authorized, comply with existing anti-money laundering or AML and counterterrorism financing, CTF laws, basically rules to prevent illicit financial activities. They also have to provide clear risk information to consumers. And interestingly, they even have to work to reduce their environmental impact. MiCA also distinguishes three categories of crypto assets: asset reference tokens, ARTs, electronic money tokens, EMTs, and then other previously unregulated crypto assets. Different requirements based on their risks.
Okay, and speaking of European developments, something just landed today, July 11th, that really emphasizes this push for clarity over there. The European Securities and Markets Authority, ESMA, just published crucial guidelines detailing knowledge and competence criteria for staff at these crypto asset service providers, or CASPs. specifically for staff giving information or advice. What's the real impact for our listeners here? Why is this so important right now?
Yeah, this is really important. The crucial point here is investor protection. Crypto assets are incredibly accessible, right? Anyone can buy them. But retail investor knowledge is often limited, and crypto itself is just highly volatile. And MiCA, well, it doesn't offer the same level of investor protections as traditional financial markets, like those under MiFID II. That's Europe's big framework for traditional financial services. So having highly competent staff is absolutely crucial to bridge that gap and, well, protect you.
I'm trying to get my head around these MiCA staff requirements. They sound incredibly detailed. What are some of the key things these staff members actually need to know? And what does that mean for someone, seeking advice or just information?
Okay, so for the staff just giving information, they need a deep understanding of the key characteristics, risks, and features of the specific crypto assets and services they offer. This includes really grasping distributed ledger technology, the secure database behind crypto. They need to understand how specific protocols like consensus mechanisms, the rules keeping the network honest, or scalability, how many transactions it can handle, and decentralization actually function. They need to know all the costs, including those gas fees, transaction fees on the blockchain. And they also need to understand how market functioning, investor sentiment, even social media impacts crypto volatility. Plus, be aware of risks like cybersecurity hacks, private key storage issues, IT programming bugs, and, crucially, they must understand the difference in investor protection between MiCA and MiFID II. This isn't just basic stuff. It sets a high bar. It requires significant professional training and supervised experience, like, for example, needing at least 80 hours of professional qualification, plus 6 months of supervised work.
Wow, okay. And it doesn't stop there, does it? What about ongoing training, keeping up to date?
Exactly. CSPs are responsible for setting annual continuous professional development, or CPD hours. For instance, maybe 10 hours for the least complex services. And this CPD has to cover regulatory changes, market developments, emerging technologies, and risks. And exams are required for this, too.
And for those actually giving advice, I imagine the bar is even higher there.
Indeed it is. Advice-giving staff. They have to meet all the information staff requirements, plus understand total costs, including advice fees. They need to understand suitability requirements, making sure a product is actually right for a specific client, and also how crypto might not be suitable for a client. Big one. And they need to grasp portfolio management fundamentals, like diversification. Their qualifications are higher, too. Options might include a relevant 3-year university degree, plus a year of supervised experience, or maybe 160 hours of professional formation, plus a year of supervised experience. And their CTD standard is higher as well, say 20 hours for the least complex advisory services, also covering market and regulatory changes.
And ESMA also issued a warning today, on top of all these guidelines.
They did, yeah. A public statement warning investors about something called the halo effect. This is basically when regulated CASPs offer unregulated products, which can kind of lead clients to overlook the risks involved with those specific products. So the mandate is crystal clear. CASPs have to communicate the regulatory status of each product at every stage of client interaction. It's a really vital reminder for you, the listener, to always check exactly what you're buying into and what rules apply.
Okay, so that's Europe. In stark contrast, the U.S. regulatory landscape, well, it's often been described as fragmented, right? And largely reliant on leading by enforcement rather than clear upfront legislation. But that might be changing. This week, we saw Crypto Week in the U.S. House of Representatives. What's behind this sudden legislative push now? Is it catching up?
Well, the crucial point here is that North America is the largest crypto market globally, period. Yet its regulation has been, let's say, complex. With federal agencies like the SEC and the CFTC kind of grappling for authority, the industry itself often argues, look, traditional finance laws just aren't a good fit for crypto's innovations. They weren't designed for it. So this legislative push really aims to provide that much-needed clarity, and it seems driven in part by a desire to make the U.S. the crypto capital of the world.
Right. So what were the key bills actually on the table during this Crypto Week, the week of July 14th, 2025? Sounds like a lot was happening over there.
Yeah, 3 significant bills were really in focus. First, there's the Clarity Act. That aims to establish clear, functional requirements for digital asset market participants, prioritizing consumer protection while, they say, fostering innovation. Second, the Anti-CBDC Surveillance State Act, H.R. 1919. Now, this bill is designed to prevent the Federal Reserve from issuing a central bank digital currency, a CBDC, basically a digital dollar from the Fed, preventing them from issuing it directly to individuals or using it for monetary policy. It reflects these fears that a CBDC could undermine financial privacy, allowing detailed tracking of transactions or even programming money for politically unpopular activities. It also tries to codify President Trump's executive order that prohibited federal agencies from pursuing a CBDC, basically ensuring Congress has to authorize any CBDC first.
Okay, so that's two. And then the third one, the Genius Act. That one passed the Senate with strong bipartisan support, 68 votes back on June 18th, 2025. And it's expected to pass the House. This one focuses specifically on stablecoins, doesn't it? That seems to be a real priority.
It does, yeah. And it's absolutely crucial for you to know about this one. The Genius Act's purpose is to create the first comprehensive federal framework for issuing and regulating payment stablecoins in the U.S. These are, digital assets designed for payment or settlement, maintaining a stable value relative to a fixed monetary amount, like the U.S. dollar.
And how does the bill define what these stablecoins aren't in this context? That seems important for legal clarity, avoiding confusion.
Yeah, it explicitly states they are not considered national currency, securities, or commodities under the Investment Company Act of 1940. This really clarifies their legal classification and helps avoid putting them under rules that just don't quite fit.
Okay. And who can actually issue these stablecoins under this new framework? Are we going to see just anyone launching a stablecoin now?
Not necessarily just anyone, no. Issuance is restricted. It's limited to federally regulated banks, federally licensed non-bank entities, which would need a special license from the Office of the Comptroller of the Currency, the OCC, and state-chartered issuers, but they're under a $10 billion cap. This framework, importantly, largely excludes most fintech startups, DAOs, those decentralized autonomous organizations governed by code and other decentralized protocols from being eligible issuers under this specific federal framework. And that's a significant point of contention for some in the crypto space, definitely.
So for you, the investor listening right now, what does this Genius Act really aim to achieve? What's the bottom line here for you?
Well, the key takeaway for you is that this bill is really aiming to enhance consumer confidence, prevent fragmented oversight between states and federal agencies, reduce systemic risk, and encourage responsible innovation by providing clear rules of the road. Now, it mandates things like 1.1 backing with liquid assets, think U.S. dollars or short-term treasuries. It requires monthly public disclosures of reserves and annual independent audits for the big issuers, those over $50 billion. It also includes robust anti-money laundering and sanctions compliance measures, and stricter oversight on entities like Tether, while limiting big tech and foreign entities from issuing stablecoins without proper U.S. oversight. And the timeline. President Trump intends to sign comprehensive stablecoin legislation into law by the August 2025 recess. So this is moving pretty fast.
Okay, so stablecoins are clearly a huge topic. The market's projected to grow from around, $250 billion today to maybe over $1 trillion in the coming years. That's massive growth. And that EY Parthenon and Coinbase survey showed 45% of institutional investors are already using them, driven by yield generation and just transactional convenience. But as they grow, their reserve models become absolutely critical, don't they? Which brings us to this fascinating conundrum about financial stability.
That's exactly right. The crucial question becomes, how do these different stablecoin reserve models actually impact broader financial stability? Let's break down the risks a bit. So narrow banking, where reserves are held directly at the Fed, okay, that provides the safest backing, theoretically. However, it risks disintermediating traditional banks, essentially cutting them out of the loop, forcing the Fed into direct funding or asset purchases, roles it's not really designed for. And this is why the New York Fed has historically rejected such attempts.
Right. And what about stablecoins that directly own Treasury bills as their backing? That sounds pretty safe, too, on the surface.
That also presents some unique risks. I mean, if demand gets really big, it could actually strain the supply of T-bills. The estimate is that demand could reach $1 trillion by 2028. And this could potentially lead the financial sector to create risky private substitutes that might fail under stress. Not good. The Fed has even subtly adjusted its overnight reverse repo facility. That's a key tool it uses to manage money in the banking system, partly to prevent stablecoins from effectively gaining direct access to central bank accounts through a kind of back door. It's a very nuanced game of financial chess they're playing.
And we've seen some of these risks play out already with stablecoins backed by bank deposits, haven't we? I mean, the headlines were pretty dramatic at one point.
Oh, absolutely. We saw the risks very clearly when stablecoins backed reserves with bank deposits. remember USDC? It briefly traded below 90 cents on the dollar when Silicon Valley Bank's fate was uncertain. This ties systemic funding directly to the crypto market cap, which is especially concerning if stablecoins grow substantially, or if they start gathering insured deposits and transforming them into flightier uninsured ones. It's a very real potential financial vulnerability.
Okay, so what about the last category? Stablecoins backed by risky assets, like Bitcoin or commodities. That just sounds like the riskiest of all from the outset.
Well, ironically, this poses the least systemic risk. If the stablecoin market remains relatively small and used mainly within the crypto ecosystem itself, in that case, price fluctuations would mostly just affect the risk asset markets. However, if these types of stablecoins become a massive part of the real economy, then the risk of holders losing significant amounts of money becomes a major concern. And that's something Congress is actively trying to prevent with bills like the Genius Act. It's really this delicate balance between allowing innovation and safeguarding the wider financial system.
Yeah, it really seems like every conversation about crypto regulation keeps coming back to this core tension, doesn't it? How do you foster innovation without compromising investor protection? The EU is setting these really stringent knowledge standards. The US is pushing hard for legislative clarity. It feels like two different but equally determined paths forward.
Absolutely. And what's fascinating here is how these two forces are trying to shape the future of digital assets. That recent TRM Labs summit highlighted how compliance is now seen not just as a cost center, but as a strategic enabler, a foundation for crypto's future. This is a really pivotal mindset shift, I think. Crypto is kind of growing up, realizing that trust isn't a luxury, it's the bedrock for mainstream adoption, making the digital asset experience seamless, intuitive, and safe for good actors.
And how is this actually impacting institutional investors? Are they still keen on getting into crypto, or is all this regulation maybe making them hesitant?
Oh, quite the opposite, actually. The surveys we've seen indicate that regulatory clarity is the #1 catalyst for growth. Institutional investors are overwhelmingly optimistic. We're seeing figures like 83% to 86% planning to increase their digital asset allocations in 2025, and a significant chunk intend to allocate over 5% of their assets under management, their AUM. This confidence, it's fueled by the growing availability of regulated investment vehicles like crypto exchange-traded products, ETPs. Think of them like crypto mutual funds trading on an exchange. And these ETPs are growing faster than any in history, apparently. Institutions are also diversifying beyond just Bitcoin into altcoins, other cryptocurrencies, into DeFi, decentralized finance, using blockchain for financial services without banks, specifically things like derivatives and staking earning rewards by locking up crypto, and tokenized assets, digital versions of real-world things like real estate or art. They're really leaning into the space now.
So as this regulatory landscape takes shape, what does the road ahead really look like for you, the investor, navigating this evolving world?
Well, the push to make the U.S. the crypto capital of the world is definitely real, driven by, as some sources say, a pro-crypto president and a supportive Congress. For you, this probably means a likely increase in regulated opportunities, which is good, but also a continued need to really understand the nuances of what's truly regulated and what isn't, especially with those ESMA warnings we talked about earlier regarding the halo effect. You always need to ask yourself, what exactly am I putting my money into, and what protections actually surround it?
So to wrap up, we've explored these contrasting regulatory approaches in the EU and the US. We've looked at the detailed guidelines coming out of Europe, really aimed at protecting you as an investor, and the major legislative efforts underway in the US trying to define crypto's future, especially for stablecoins. We've seen how regulatory clarity has become this key driver for institutional adoption, and how compliance itself is shifting, from just a burden to a strategic enabler for the whole digital asset ecosystem.
Yeah, and as the global crypto landscape moves from that Wild West feeling to a more structured environment with dedicated crypto weeks and strict competence guidelines, maybe consider this. How might this increased regulatory certainty, even with its different international flavors, fundamentally change your personal relationship with digital assets? Not just as investments, maybe, but as potentially an integral part of the global financial system going forward. Something to think about.